Hello and welcome back to another lesson. This is Bernd Skopinski with another lesson in the OTC Blueprint program. Today we will start discussing a new topic, which is charts. In this lesson we will take our first look into our beloved charts. Understanding this lesson will be very important once we go into the process of analyzing supply and demand and unfilled orders within those charts. So we are going to cover the definition of charts, followed by definition of candlesticks and advanced understanding of candlesticks. Then we are going to go into a little bit of a practical application. Lastly, we are going to look at the different time frames and income types and how they relate to our trading strategy. Let's get started. What are charts? Charts visually represent the movement of prices over time. The horizontal axis represents time. The vertical axis displays the price. Each candle you see captures price activity within a specific time frame. For example, a 5-minute candle shows price movement during that time, from 12:20 to 12:25 p.m. Standard Eastern Time in this case, as the price is around 5,737.2. Candles can represent different time intervals from as short as 1 minute to as long as a month, allowing traders to zoom in or out on price action. A crucial point is that charts show filled orders. Now, what do I mean when I say filled orders? Filled orders are transactions that have already taken place. So a buyer and a seller have already been matched. There's, however, a high probability that not all orders have been filled. Willing buyers that wanted to buy at a specific price did not find a seller. In other words, not all buyers and sellers have been matched. Buyers who, for instance, wanted to buy at 5,730 but weren't matched before the price climbed to 5,737, these unfilled orders, also referred as hidden orders, still reflect interest at that price level. Understanding this can help traders anticipate potential price movement and areas of strong interest on the chart. In short, a chart represents filled orders. What we will focus on in this program is how to identify hidden unfilled orders. I promise this will make sense further down the road, so stay with us. Let's examine candlesticks more closely. Each candlestick displays a high, low, opening and closing price of an asset for a specific period. The time periods are called time frames. You could look at 60-minute, daily or monthly time frames and anything in between. The body of the candle shows us the initial and last price of the asset during a specific time frame. In the case of a green candle, the lower part of the body would be the opening price and the upper part of the body would be the closing price. For the red candle, it's vice versa. The wicks show us the entire trading range during a specific time frame. The range. Let's assume these are 60-minute candles. The wicks would tell me that during these 60 minutes, the price of the asset has chopped at least once below the opening price and was at least once higher than the closing price. For example, let's look at the green candlestick to the left. This candle opened right here. Then maybe it went down first, after which you had buyers pushing back price higher all the way until the high. Then you had a few sellers coming in. And eventually the candle closed right here. On the other side, you have price opening right here. Then maybe it went up first. Then sellers came into play, pushing price lower all the way down to the low. And eventually price closed right here. So we use candlesticks to illustrate price movement and to give us precise buy and sell points in any market. Let's dive a bit deeper into candlesticks. Imagine we are looking at Meta, whose stock is trading at $500 per share. This price reflects the most recent transaction where a buyer and a seller were matched. For any given price, there's a pool of willing buyers, represented here in a green box on the left, and willing sellers in a red box on the right. A willing buyer is someone, whether a retail trader or any market participant, who wants to buy but hasn't yet been matched with a seller. Until this happens, their order remains open, waiting to become part of the filled transactions you see reflected in each candlestick. Makes sense so far? You have willing buyers and willing sellers at the specific price of $500, and they are being matched until one force becomes zero. In this case, you still have willing buyers left, aka demand, but you have zero willing sellers left, aka supply. Therefore, you have higher demand than supply for that specific price. Again, economics 101. Where's price going to go and what's the color of the candle that's going to be formed? Price is going to go up and the candle is going to be green. Now, the origin of demand will be at $500 because at that price there was an imbalance between demand and supply. There are still willing buyers left that haven't been matched with willing sellers. These willing buyers still want to buy at that price. In this example, the willing buyers and the willing sellers that have been matched formed the candle. In other words, filled orders. The willing buyers that are still left are the unfilled orders that we are going to look for within the chart. To sum it up, the relationship between supply and demand defines the direction of price. If demand exceeds supply, then prices go up. Vice versa, if supply exceeds demand, price goes down. Now the takeaway is that price changes when one force, buyers or sellers, becomes zero at a specific price. And the science of trading, supply and demand, is to identify the origin of this change, because we know that there may be a lot of unfilled orders, willing buyers left at an origin of demand, or willing sellers left at an origin of supply. We will have plenty of time to cover the rule on how we are going to find this origin of imbalance at a later stage. But for now, let's dive into a practical application and take a look at the charts. Ladies and gentlemen, welcome to this lesson's practical application session about charts. It's going to be a very basic practical application, so if you are a beginner, please stick with me. Now, what is a chart? First of all, we are here on our Campus Fund trading platform, which is TradingView, where we execute and analyze all our trades. Now a chart. You have the vertical axis here to the right. And the vertical axis you see here represents price. You have down here the horizontal axis that represents time. So what is a chart? It's historical price movement through time. Very basic. Now let's go into the candlesticks. We are here now on the Euro US dollar on a daily chart. So every single candle here represents 1 day of trading activity. One full day of trading activity. Now I can go to the weekly chart. And on the weekly chart, you might guess it, every single candle represents 1 full week of trading activity. And I can go all the way down to 1 minute, or I can go to a monthly chart. Let's go to a 5-minute chart. And you see every single candle now, you get more candles on the chart basically. Every single candle represents 5 minutes of trading activity. And let me quickly go now, therefore, back to a daily chart to explain the candles. Now the current day. And for that, I use a horizontal line. The current day opened here. It's still green. It's a green candle right now as we speak. So the day is still ongoing. So you see how it's moving slightly. It's a daily chart. So it's opened here, so it's green. So the open still is below the close. That's why it's a green candle. And that I use another horizontal line. Price traveled all the way up here. You see now the candle basically is moving to a red candle. We talk about this in a second. So it moved all the way down here. So this is the bottom of the candle. And it moved all the way up here. And if that candle closed right now, well, you would see that the closing and the opening, that's why you have only a dash here, you basically don't have a body, would be almost at the same price. You see that here. But you see also that right now, since it's a red candle, you see that now the close price is trading lower than the open. That's why it's a red candle. But this is the entire range of the candle, from the lowest wick to the highest wick. Now let's go to yesterday's candle. Yesterday's candle, so why is it red? First of all, why is it red? Because the close is below the open. And you see that here, the open is here, the close is there. And now, well, price traveled all the way down here. You see that wick here. And on the top, there's almost, you see that here as well, almost no wick. Traveled all the way up here. So from here to here, that's the range of the candle. That's where price traveled. And then you have a red candle, you have a red body, because you had selling pressure throughout that day from open to close. And it's red because the open is above the close, or in other words, the close here is below the open. Now the same exercise we can do on a green candle. We can use this candle here. So it's a green candle. Why? Because we see buying pressure here on that green candle. Now it opened here. This is the open. This is the close of the body. So you see the open is, well, here below the close, or in other words, the close is above the open. And here is the entire range. Price traveled all the way down here, traveled all the way up here. And what we can see is literally that the range is from here to here. And the open, it's a green candle because the open is down here. It's below the close. Now you see today's candle, because there's right now a lot of volatility, we can do again the same quickly exercise. It's now getting, it was, you see, where before we just started, the open and the close was pretty much at the same price. Now it's getting a very, very deep red candle. You see, it traveled all the way up here, and you see the selling pressure. Sellers are pushing price lower right now as we speak. So what you will learn during the trading, during the supply and demand module that Tobias is teaching you, is this represents right now filled orders. Orders are getting filled in the market. But our goal as a trader, you will learn this as well, are finding the unfilled institutional orders. But the chart represents the filled orders, filling orders. And yeah, the goal as a trader is to find the hidden unfilled orders. This will be the goal throughout the program in the supply and demand module. I just wanted to tease that already. So now you see, as we speak, it's very exciting, this price action right now here. So now if candle closed as we speak, you would see here the wick right now, and right now the buyers are trying to push it higher, 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 higher. If we went all the way to now a 5-minute chart, you would see the candles are being much, much bigger, because this is just a 5-minute chart and it represents only 5 minutes of trading activity. So 5 minutes of filling orders. You see on a daily chart, which was right now a relatively quote unquote smaller candle. You see that big candle that caused the daily chart right now on that 5-minute chart. You see here a lot of selling pressure on that 5-minute chart. It pushed price all the way down here. Now, quickly, on that daily chart. Now, very interesting. A trading week has 5 trading days. So 5 trading days represents 1 trading week. So if I combine 1, 2, 3, 4, 5 trading days here, I know how my, the weekly chart, or my weekly candle currently looks like. So the low of the weekly candle of the week is down here. You see 5 candles represent 1 week. And the high of that week was all the way up here on that daily chart. Now the week, this was the first candle in the week. It opened here on Monday. It opened here. Today is Friday. You see sellers are pushing it down. If candle was about to close right now, it would close like this. So what color would the candle have? Price first of all traveled from here all the way up here. Price opened here. If price was about to close, the sellers are pushing it down right now. But you see, this week, the close is still below, the open is below the close, so the close is higher. So the weekly candle, if we go now to weekly candle, surprise, you see, is a green candle, and it's exactly the low, the high, the open, and right now, since the day is still ongoing, the close is still not defined. And the same, by the way, for a weekly chart. A week, or let's go to a monthly chart. A monthly chart represents basically 20 trading days, so 20 daily candles, or 4 trading weeks for weekly candles. So 4 weekly candles represents 1 monthly candle, and 20 trading days represent 1 monthly chart as well, or 1 monthly candle in other words. All right, so these are charts, and I'll see you in my next lesson. Thank you for watching, and see you then. When talking about income goals, we have to discuss the different time frames related to them. There are 3 different income goals: monthly income, weekly income, and daily income. If we are looking for longer term trades, these are considered monthly or weekly income. So we look at higher time frames. If we are targeting daily income, then we look at lower time frames. In OTC, our main focus is on midterm to long-term trades. So we ideally focus on weekly income and monthly income in line with higher time frames. Why? Because the higher the time frame, the more unfilled orders, in other words, the more imbalances in terms of supply and demand we will be able to spot in the chart. Daily income, though, is also possible and is used by us. But it comes with its own caveat, as there are less unfilled orders when we trade the lower time frame. And with that, we conclude our lesson for today. See you in the next one.